Hello traders, welcome to this special video. I'm Juan Maldonado from Elliott Wave Street, and today we are going to cover the 5 tips from a professional trader to make sure that you're gonna make a lot of money in the markets by mastering these 5 tips or principles. Of course, everything under the frame of the Elliott wave theory, which I believe is one of the best ways of analyzing the markets. So let's start. The first tip we are going to go through today is the emotions or the trading psychology, because emotions are 90% of your success. Managing these emotions are going to be at the end 90% of your success. You could be great at analyzing the markets, are triggering the trades, are knowing the candlestick patterns, knowing the Elliott waves, knowing this and that. But if you don't manage your own psychology, your own emotions, this is not going to work for you. So 90% of trading, of successful trading, is coming from these emotions. So the first step is that you need to understand that managing your trading psychology and learning techniques to trade the markets in a smart way is key. There are many mistakes that the trader makes every day that are not related with the direction or with the strategy. For example, not using a stop loss, or probably using a huge stop loss. I have been seeing traders who trade with 10% of the account or 5% of the account. And that's absolutely insane, because one of the key things in order to make money in this business is managing the risk and making sure that the losses are small and the gains are big. So, of course, if you want to either have a huge stop loss because you don't want to get stopped out, or have a huge position because you want to duplicate your account in the next trade, at the end, you're going to lose everything. So the point is that trading is not to duplicate the account or to make something huge per month in terms of percentage, because the cons of trying to do so is that you need to risk a lot. And when you risk a lot, game over, my friend. That's it. You're going to absolutely kill your account and you're going to kill your capital. So make sure that one of the key rules in order to start managing your emotions is, of course, risking 1% or less. Sometimes less is even better per trade, and that opens the door to the second tip. The second tip is being consistent in your risk. Because you can make this exercise once you finish this video, or you can pause the video and have a look at your statement and come back here and let me know in the comments your findings. Because so some traders have a trading plan and they say, I don't risk more than 1% or 2% of the account. But let's say that you have a $10,000 account, and your risk then is going to be, if it's 1%, will be $100 per trade. Now, check your statement. And if you are seeing on your statement some losses of, let's say, minus 200, others minus 150, others minus 80, another one minus 250, another one minus 400, another one minus 70, another one minus, let's say, 120, right? So you can start seeing the pattern that you, first of all, you're not risking the same per trade. Some trades you're losing more than the 100, and some other trades probably lower, but you are not being consistent in your risk. When I check the trader's a balance sheet or the statement of the accounts, this is one of the key things that I'm started looking at. Is the trader consistent with his losses? Because let's face the truth. If you are not having roughly the same loss in all your trades at ideally 1%, you are not going to make it. Trust me, you are not going to make it. So just by watching and studying your statement with your past trades, you know that you are not going to make it. And you can become the most expert trader in the Elliott theory, or the volume profile, or the candlestick patterns, or this and that. And you are going to continue losing more money. So, first step, check your statement. Write here in the comments your findings. Are you consistent in your trades? Let me know. So, that's key, to be consistent, because usually the equity line, the equity curve in your platform, when you are not being consistent with the losses, is going to be something like this. You are in the break even, and because you don't have the 1% loss, or you're risking 10%, let's say, you have a big drawdown, and then you stabilize the account again. Probably you have a winner, and then you have another loser, and your equity curve starts looking in this manner, like a bear trend. And no matter what technique you learn, always is going to look like that. So that comes to the third tip, that is being consistent with the strategy. Let's face real numbers, traders. Some traders believe that this is an easy business where you can make a lot of money, where you can become a millionaire if you duplicate the risk, or if you learn a new technique, or anything that you are looking for new, that you are going to become millionaire. And of course, it doesn't work like that. The reality of trading is that roughly, of course, you can beat these numbers, but roughly 15% of the trades are likely to go directly to the stop loss on a good trading strategy or system. 70% of the trades are likely to show little gains or break-evens. And 15% of the trades are going to be home runs. So if you don't manage the risk on these 15 trades or on these 70 trades, you're wasted. That's it, right? That's a reality. Because the 15% of good trades are not going to be able to lift your account. So being consistent with your strategy, of course, is related as well with your risk management. When you understand these numbers, when you really understand these numbers, and when you stop searching for things that are not going to work, that are going to waste your time, I know traders that have been trying to make a successful trading for years, 10, 20 years, without results. They have been taking all the courses, they have been reading all the books, they have been buying all the indicators, and they are not making money. And there are some traders who start with simple strategies and they start making some good money. So the question is the trader that knows more techniques the one that is going to make more money? Nope. Trust me, that is not a truth of the market. Is not a truth of the market. The trader who knows everything is the one that makes money? Nope. That's not true. You can check professor in a university, and he knows everything about the economy, and he has been spending the last 40 years learning all the techniques and all the complex things about the economy, and ask that professor to go and trade. And of course, he's not going to make money. He's an expert, and he is providing a lot of value to his students and everything. That's good, of course, but he's not going to be good at this business or making decisions for a company, because trading is something different. He's not the one that knows more. He's the one that knows how to act when things work and when things don't work. When you finally manage this key point, you are going to start seeing your equity curve something like this. You are going to be in a break-even, let's say for 1 week. Eventually, you're going to capture one of these home run trades that are like a 1-to-4 risk-reward ratio. So if you survive on the trades that don't work, are break-evens or little losses, and then you got your home run, you are going to push your account into the next level. It could be 3% or 4% higher. Then it's going to come another period of sideways or bad trades, of break-even trades, of being patient. And then you have another home run and you push your account in that direction. You can see that this equity curve is bullish and this one is bearish. And what's the main difference? How you can get to this equity curve? Understanding that 70% of your trades are going to be break-evens, 15% are going to be 1% losers, and understanding that you have to let run the winners. And of course, if you are not using a 1% rule or less of risk, and you have big losses, those home runs are going to the other side. So your equity curve is going to start looking like this. So one of the first steps that you have to apply in your statement is check the losses. Have a look at your losses. Are consistent or not? Make sure that you make this exercise. So this is extremely important, traders. So let's go to the fourth tip. Is the risk-reward ratio. When the trade is working, let it run, because that's the only thing that can make us make money in these markets. Look at this move up. We have fat tails, which means that if, for example, we start a bullish trade after the second wave here, something that we did in our membership, we started to buy here the S&P. And if this is the risk, this is the one, at the 1-to-1, I like to book partial profits, right? And then you have the 1-to-2, the 1-to-3, the 1-to-4 on the other half of the trade. So the 1-to-5, the 1-to-6, and if you book partial profits, of course, it's not going to be a 1-to-6 at the end. It's going to be a 1-to-4 in average, adding the one that you already did, right? But learning how to let the trades move, understanding when the waves, when the cycles are over, and trying to squeeze as much as you can each trade is another important part. Because remember that only 15% of your trades are going to be these type of home runs. So when they happen, those are the ones that are going to push your equity to the next level. So the risk reward is absolutely important in this equation as well. Make sure that you have a technique to let the trade run, to let the trade move in that direction that you're looking, and try to capture as much as you can. Fat tails. The next step, traders, the next tip number 5, is that I have been finding after training thousands of clients over the last 15 years, I found that another problem, another psychological problem that the trader faces is money. Because let's suppose that you have a small account, $1,000 account. The trader wants, of course, to make a living from this small amount of money. That's impossible, because let's suppose that you have a month where you made 1% of the account. That's something that makes sense. A professional trader can make 1, 2, 3% of the account. That's something good. Of course, as everything in life, there are traders that can duplicate an account in 1 month, but of course they are going to lose that money on the next month. That's not the plan, right? The plan is to have a real business. So let's suppose that the trader makes a 1%. So a 1% on a $1,000 account is going to be $10. With $10, you can't do anything, you maybe buy an ice cream nowadays, right? That's it. And of course, after a hard month of work, you are going to feel extremely frustrated with $10. So what you say, okay, I'm making money, let's increase this risk to 10%. And precisely you have three bad trades in a row, let's say, and your account moves down to $700. And you start feeling desperate because, of course, you're losing a lot of money, almost half of the account, and you start making crazy things. And over the last 2 days or 24 hours, your account comes to $10, and that's it. And the account is gone. This is the story that repeats and repeats and repeats. And the reason to happen these type of things, of course, is the small capital. The small trading capital comes with this psychological pressure of increasing the risk. And remember that when you increase the risk to 1% or more, that's it. That's your end. It's impossible to make money. It's absolutely impossible to make money if you risk more than 1%. Now imagine traders who don't have a stop loss, who don't manage the risk at all. Rather sooner than later, the game is over. They are going to burn all their money in the markets. So of course, something that is going to happen. So that's important too. But the next problem is how to get money then, if you don't have it. Should you apply for a loan and try to get a $100,000 account? That's going to solve the problem? Absolutely not. Never trade money that is not yours. Never. That's going to be a disaster because you're going to pay interest. You are going to have you need to pay a monthly interest and principal for that money. And what if you lose the money? What if the broker comes out of business and they take your money? There are so many risks, right? So it's not a solution. So in these cases, traders, I believe that the best thing to do is getting a funded account. Nowadays, there are many companies that are offering the funded accounts, and you only pay a fee or a monthly fee, whatever, for taking an evaluation. And if you pass the evaluation, you are going to trade that money, and you are not going to risk your own money. And you can get big accounts, 500K accounts, 100K accounts, 50,000 accounts, so 50K accounts. So, of course, this is different, because when you have this type of money, when you make on the 500K account 1%, you are making $5,000 a month. With 1%, with just making 1% of the account. If you can do better, great, you can make more money. But something that I tell my clients, hey, start with this simple target, making 1% of the account. So you can either risk per trade less than 1%. So you don't have that pressure. The losses are tiny, the gains are good, right? And after a hard month, or after working hard over a month, you say, okay, I make a 1%. Awesome. And then you can add money. You can have a bigger accounts. There are bigger accounts, right? But make sure that you master this part of the puzzle first. Or if you have a 100K account, then you can go with $1,000 a month, right? Just good. Or here the 50K account with $500 a month. Just with 1%, probably you will make more than 1% a month. 2%, 3%, those are good numbers. 3%, 2%, 1% are good numbers, right? If you make more, fantastic. But the psychological pressure of risking a small percentage of the account is going to relieve your trading, because instead of trying to duplicate a $1,000 account, you are making just a 1% of a bigger account. And that's what makes the real difference. There are many funded account programs nowadays. We offer one here on Elliott Wave Street. We have one that is fantastic. We are educators, so it was created by educators with simple rules and simple ways of having the evaluation of the real account without monthly fees and all that stuff. If you're interested, I'm going to leave you the link on the video description box, so you can check it out. So that's the fifth tip. That's tip number 5. It's important to have enough money, because this changes the equation. Instead of duplicating your account, you can make just a small percentage and make good money. I think this is a game changer, and even better if you can trade money from a fund and not your own money. Of course, even better. If you have some savings, make other investments, buy real estate, buy a certificate deposit, buy anything, a bond, a government bond. Invest that money in something really, really safe, so you are not gonna lose your savings and your hard-earned, worked money and trade a fund account. That's my advice now that we have all these opportunities nowadays. Traders. So, for example, here, coming back to the Elliott theory, we found this buy trade here after the end of the second wave. It was a great trade as well. Here we did the same. We have a fantastic membership on Elliott Wave Street, which I share with you my trading plans, are real trading plans from a professional trader, and you are going to have access to these trading plans in real time. So we were looking for the second wave, the rejection. Now we are adding smart money concepts. We have a whole lesson on this topic. So here we have a change of behavior. If you want to learn how to use the smart money concepts along with Elliott Wave, is included in the membership. And here we have the costs, and we are looking for the start of the effect. So in this particular case, we knew that the price was likely to come up here to the previous high. The next step in this process, traders, is looking for a good second wave. There we have it. There we have the rejection. And we have a green light to follow the price up, to follow the price to the previous high. So in this case, we got two consecutive trades, two consecutive home runs in the direction of the trend. That's another important part. Always trade in the direction of the trend. Never try to fade the trend. Imagine those sellers of the S&P these days. They have been losing a lot of money, of course, right? So of course, it's something terrible here. We're expecting to have the price on the S&P continuing higher, probably the 900, and all the corrective waves are to find the end of those waves and continue in the direction. So of course, when you add a technique like Elliott Wave, that, trust me, is something fantastic, is something that is going to change your life forever. And you're being careful with the risk, and you don't have a pressure of making a lot of money of your account. You can take it easy. You can reduce the risk. You can wait for good trades. You will understand that some trades are not going to work as any business, and you are going to do it. I'm sure you are going to do it. You have everything in your hands to do it. So make sure to comment in this video your thoughts. Let me know if you agree, if you disagree, what is your strategy, what do you think about these concepts, and if you want to have access to this fantastic library of education, of Elliott Wave-oriented education, of live market analysis, here on ElliottWaveStreet.com, you can access to the membership. We're having this special offer of $19 the first month on the forex or the stocks or the full access. We also cover futures on all the plans. We cover the ES, the Dow, the NASDAQ, all these futures on a daily basis. So you will get access to the live market analysis with our opinion, with the education library. We have a lot of courses, price action that comes with the smart money concepts, the volume profile to learn the auction process. You're going to love that course. The momentum course and others, the Elliott Wave crash course and others. So you can sign up and you will get immediate access. You are going to unlock this world of opportunities. So traders, that's it. Please have a great start of your week. I'll see you inside the membership. Take care. Bye-bye.